Dubai is becoming richer than ever. And yet, much of that wealth doesn't truly belong to it. Chinese money is flooding into the Gulf, buying penthouses, acquiring entire floors of luxury towers, parking billions into assets that stretch across the skyline. From the outside, it looks like the next great wave of globalization, a new chapter of East meeting Middle East. But look closer, and something doesn't add up. Because this wealth, despite its scale, despite its visibility, doesn't behave like traditional investment. It doesn't settle. It doesn't root itself. It doesn't build in the way we expect capital to build. Instead, it hovers, quietly, strategically, almost temporarily. Lights off in multi-million-dollar apartments. Entire units owned, but rarely occupied. Transactions happening at record speed, with little trace of long-term presence. This is the paradox. Why is one of the largest inflows of wealth into Dubai's history, creating spaces that feel increasingly disconnected from real life? On the surface, the story is flawless. Dubai continues to position itself as the ultimate safe haven for global elites. Tax efficiency, political neutrality, a luxury ecosystem designed to absorb wealth from every corner of the world. And for Chinese investors facing pressure both at home and abroad, it offers something rare, a place to move capital without friction, without scrutiny, without delay. But beneath that polished narrative, a deeper shift is unfolding. Because not all money comes with the same intention. Some money builds empires. Some money chases returns. And some money is simply looking for an exit. The question is not just why Chinese capital is arriving in Dubai. The real question is, what is it trying to escape from? Before we break down what's really happening beneath the surface, make sure to subscribe if you're into deep, no-nonsense analysis like this. Because this story isn't just about Dubai or China. It's about what happens when global wealth starts moving, not toward opportunity, but away from risk. To understand why this moment is different, you have to understand how Dubai built its identity in the first place. Dubai didn't become a global hub by accident. It engineered itself into one. A city with no significant natural resources compared to its neighbors, that transformed itself into a magnet for capital, trade, and luxury. It built the infrastructure first, then attracted the world to fill it. Free zones, world-class logistics, a financial system designed for speed, a real estate market optimized for international buyers, and above all, a reputation, a carefully constructed image of stability, opportunity, and limitless growth. Over time, that image became reality. Wealth from Europe, Russia, South Asia, and beyond began flowing in, each wave reinforcing the same belief. Dubai is where capital goes when it needs freedom, when it needs flexibility, when it needs to move. But the system wasn't just built to attract money. It was built to accommodate a very specific type of money. Mobile capital. Capital that doesn't want to be tied down, that values optionality over permanence, liquidity over commitment. And for years, that model worked perfectly, because the world itself was stable enough to support it. Globalization was expanding. Trade was growing. Cross-border movement was increasing. Capital flowed freely, and Dubai became one of its key destinations. Then something changed. Not suddenly, but steadily. In China, the environment for wealth began to tighten. Regulations increased. Oversight deepened. Entire industries faced unexpected crackdowns. The implicit rules that once governed the system became less predictable. At the same time, in Western markets, Chinese capital faced growing scrutiny. Deals were blocked. Acquisitions were questioned. Financial flows became politically sensitive. And just like that, two major destinations for Chinese wealth became complicated. One from within, one from outside. That's when the shift began. Not as a flood, but as a quiet redirection. Chinese capital started looking for a new kind of destination. Not just profitable, but neutral. Not just open, but vast. Not just accessible, but discreet. Dubai fit that profile almost perfectly. And so the inflow accelerated. Luxury real estate transactions surged. Developers began targeting Chinese buyers more aggressively. Entire segments of the market adapted to this new demand. From the outside, it looked like another success story. Another wave of global wealth reinforcing Dubai's position as a financial hub. But beneath that momentum, a subtle misalignment began to form. Because this wasn't the same kind of capital that had arrived before. It wasn't looking to integrate. It wasn't looking to build long-term ecosystems. It wasn't looking to stay. It was looking for something else entirely. Protection, distance, flexibility. And that distinction, small at first, changes everything. Because cities don't just need capital. They need commitment. They need presence. They need people who live, spend, and participate in the economy beyond the transaction itself. When that layer is missing, you get something unusual. Growth that looks strong, but feels strangely hollow. And that's where the first cracks begin to appear. Not in headlines, not in official statistics, but in patterns, in behaviors, in the quiet spaces between transactions. Which brings us to the next layer of this story. Because if this is the surface, then what's happening underneath is far more revealing. In the next section, we'll break down the real drivers behind this shift. Why Chinese capital is moving the way it is. What pressures are forcing it outward. And why Dubai may not just be attracting wealth, but absorbing global uncertainty itself. Capital doesn't move without a reason. Especially not at this scale. Especially not this quietly. When billions of dollars begin shifting across borders, not in headlines, not in dramatic sell-offs, but in controlled strategic flows, it's usually not chasing opportunity. It's responding to pressure. And to understand the Chinese money arriving in Dubai, you have to start with what it's moving away from. For decades, China's wealthy operated inside a system that felt predictable. Not transparent. Not fully open. But predictable enough. There were boundaries, but they were understood. Growth was rapid. Assets appreciated. And if you stayed within the lines, wealth could expand almost indefinitely. But over the past few years, those lines started to move. Entire industries were reshaped almost overnight. Tech giants faced sudden regulatory intervention. Real estate, the backbone of domestic wealth, entered a prolonged slowdown. High-profile entrepreneurs disappeared from public view and reappeared under very different conditions. The message wasn't always explicit, but it was clear enough. Control had tightened. And more importantly, predictability had weakened. For ultra-wealthy individuals, unpredictability is the highest form of risk. Not volatility, not even loss, but the inability to forecast the rules of the system itself. Because if the rules can change suddenly, then no asset is truly secure. No structure is fully protected. And when that realization sets in, the response is rarely emotional. It's strategic. Capital begins to diversify, not just across industries, but across jurisdictions. And this is where the shift begins. Not as a panic, but as a quiet recalibration. But moving money out of China isn't simple. In fact, it's designed not to be. Capital controls are one of the key tools the government uses to maintain financial stability. Large-scale outflows are restricted, monitored, regulated through layers of approval, which means the movement we're seeing is not happening directly. It's happening through channels, through structures, through intermediaries, family offices, offshore entities, trade mechanisms, asset conversions. Money doesn't leave in a straight line. It moves in fragments, gradually, carefully, and when it arrives in a place like Dubai, it doesn't arrive as Chinese capital. It arrives as global capital, delinked, repositioned, ready to be deployed. But here the key detail. By the time it reaches Dubai, its primary objective has already changed. It's no longer seeking maximum return. It's seeking maximum flexibility. At the same time, the traditional destinations for global wealth began to shift. In cities like London, New York, Sydney, Chinese capital once flowed freely into real estate, businesses, and financial markets. But that environment has changed. Political tensions increased. National security concerns entered the equation. Cross-border investments became more sensitive, more visible, more regulated. Deals that once would have been approved quietly now face investigation, delay, sometimes outright rejection. And even when they go through, they come with scrutiny. For capital that values discretion, this becomes a problem, because visibility is risk. Attention is risk. So the equation changes again. Not just, where can this money grow? But, where can it exist without being questioned? That's a very different question. And it leads to very different destinations. Why Dubai fits the gap? Dubai doesn't compete on the same terms as Western financial centers. It doesn't emphasize transparency in the same way. It doesn't impose the same layers of scrutiny. It doesn't slow capital down. Instead, it accelerates it. Fast transactions, flexible ownership structures, minimal taxation, a system designed to absorb capital quickly. But more importantly, Dubai operates in a geopolitical gray zone. It is not directly aligned with Western regulatory frameworks, but it is also not in opposition. It exists in between, and that in-between space is exactly what this kind of capital needs. A place that is connected to the global system, but not constrained by its most restrictive elements. A place that offers access, without exposure, the true nature of this money. At this point, the narrative starts to shift in a critical way. Because we need to redefine what we mean by investment. Most people assume investment equals growth. That capital enters a market to build something, to generate returns, to create economic activity. But that's only one type of capital. There's another type, far more cautious, far more strategic. Capital that is not trying to expand, but to preserve, to remain liquid, to remain mobile, to remain outside of any single system's full control. And increasingly, that's the type of capital flowing into Dubai. It doesn't need to be productive. It just needs to be safe. And that changes everything. Because when capital is driven by preservation, it behaves very differently. It avoids deep integration. It avoids long-term commitments. It avoids anything that reduces its ability to move. Which is why we're seeing luxury properties purchased but not occupied, assets held but not activated, wealth stored but not circulated. From a macro perspective, everything looks strong. High transaction volumes, rising asset prices, continuous inflows. But at the micro level, a different reality begins to form. One where ownership does not translate into activity, where presence does not follow purchase, where value exists without usage. The first signal of imbalance. And this is the first real signal that something deeper is happening. Because economies don't just run on capital. They run on circulation. Money needs to move through the system, to create jobs, to generate demand, to sustain ecosystems. But when large amounts of capital remain static, parked in assets, disconnected from daily activity, the system starts to lose depth. Not immediately, not dramatically, but gradually, in subtle ways. Quiet buildings, underutilized spaces, clusters of high-value assets with low real engagement. And at first, it's easy to ignore, because the headline numbers still look strong. But over time, these small imbalances begin to add up. And that's when the question becomes unavoidable. What happens when a city attracts more capital than it can actually absorb in a meaningful way? Because absorption isn't just about ownership. It's about integration. And right now, that integration is incomplete. Which brings us to the next layer. Because if this section explains why the money is moving, the next section explains what happens when it doesn't behave the way the system expects it to. What happens when capital that was never meant to stay starts shaping the city anyway? By now the pattern is clear. Chinese capital is not arriving in Dubai by accident. It's moving with purpose, with caution, with a very specific objective, flexibility. But here, where the system begins to strain. Because Dubai wasn't just built to receive capital. It was built to convert it. Convert investment into activity. Convert ownership into economic energy. Convert wealth into a living, breathing ecosystem. And that conversion depends on one critical assumption. That capital, once it arrives, will participate. But what if it does? The breakdown of the traditional model. In a typical growth cycle, the process is straightforward. Investors buy property, right arrow, they use it, rent it, or develop it, right arrow, activity increases, right arrow, businesses grow, right arrow, demand expands, right arrow, the economy deepens. It's a loop, a self-reinforcing system. But when capital enters without the intention to engage, that loop breaks. The transaction still happens. The asset still appreciates. But the follow-through never comes. No long-term residence. No sustained consumption. No embedded economic activity. And over time, that creates a gap between financial growth and real-world vitality. The rise of dark assets. There's a term often used quietly in financial circles. Dark assets. Not illegal. Not hidden. But inactive. Assets that exist on paper. Hold value. But generate minimal real-world activity. In Dubai, this concept is starting to surface in subtle ways. Luxury apartments with minimal occupancy. Entire floors purchased through offshore structures. High-end developments that feel vibrant during launch, but noticeably quieter afterward. From a distance, everything looks successful. But up close, the energy doesn't match the valuation, because these assets are not being used as homes, or offices, or community spaces. They are being used as storage. Storage for capital, storage for optionality, storage for uncertainty. Why this matters more than it seems. At first glance, this might not seem like a problem. After all, money is still flowing in. Developers are still building. Prices are still rising. But here's the issue. Economic systems don't just need capital. They need circulation. They need money to move through layers of activity. From property to services. From services to wages. From wages to consumption. That's what creates depth. That's what creates resilience. But when capital becomes static, locked inside high-value assets without generating downstream activity, the system starts to thin out. It becomes more dependent on new inflows to compensate for the lack of internal movement. And that's where the risk begins. The feedback loop no one talks about. Here, how the cycle quietly evolves. More capital arrives, right arrow, assets increase in value, right arrow, more investors are attracted, more assets are purchased, but activity doesn't scale at the same rate. So the system compensates by attracting even more capital to sustain the appearance of growth. It becomes a loop driven less by usage and more by expectation. Expectation that demand will catch up, that occupancy will rise, that activity will eventually fill the space. But what if it does? What if the capital driving the system was never designed to create that activity in the first place? The role of behavioral alignment. This is where the deeper issue emerges. Dubai's model works best when two things align. Capital that wants to grow, people who want to stay. When those align, the system thrives. But what we're seeing now is a divergence. Capital wants flexibility. People, at least a portion of them, want mobility. Both are optimizing for exit, not permanence. And when both sides of the system are designed to move, the center becomes unstable. Not in a dramatic way, but in a structural way. The city continues to function, but its foundation becomes more dependent on continuous motion. The illusion of permanent demand. One of the most powerful beliefs in any booming market is this: there will always be demand. And for a long time in Dubai, that belief has held true. Because as one wave of capital slows, another arrives. Russian money, European wealth, regional capital, and now Chinese investors. Each wave reinforces the illusion that demand is infinite. But what if demand is not infinite? What if it's cyclical, rotational, dependent on external pressures rather than internal strength? Then the system begins to look very different. Not as a permanently expanding market, but as a platform constantly cycling through different sources of capital. And that means stability is not guaranteed. It's conditional. Conditional on the next wave arriving, before the previous one begins to exit. The moment before shift. Right now, Dubai is still in the inflow phase. Capital is arriving. Prices are holding. The narrative of growth is intact. But beneath that, the composition of that growth is changing. More capital is passive. More assets are underutilized. More value is tied to expectation, rather than actual activity. And that shift is subtle, almost invisible until it is. Because systems like this don't break suddenly. They transition from one state to another, from growth driven by expansion to growth sustained by maintenance, from active economies to financialized environments. And once that transition begins, revering it becomes far more complex. Which brings us to the final layer. Because everything we've discussed so far, the inflow, the behavior, the misalignment, these are not isolated phenomena. They are all expressions of a deeper structure, a model built on one core principle: that capital will continue to move in the right direction. In the final section, we're going to break that model down completely. What Dubai really is beneath the surface, why it works so well until it doesn't, and the question that ultimately defines its future. If the flow slows down, what replaces it? By now, the illusion is harder to ignore. Chinese money is arriving in Dubai, but it's not behaving like traditional investment. It's not anchoring. It's not integrating. It's not building the kind of economic depth that turns capital into permanence. And that forces a deeper question. What kind of system produces this outcome by design? Because this isn't a flaw. It's a feature. Dubai was never meant to be a traditional city. It was engineered as a platform for movement. Capital moves in. People move in. Opportunities are created. And then, when conditions change, they move out. This is not an accident. It's the core architecture of the system. The engine, flow, not foundation. Most economies are built on foundations. Domestic industries, local demand, long-term capital. Dubai is built on flows. It doesn't rely on what it produces internally. It relies on what it attracts externally. Trade flows, tourism flows, financial flows, migration flows. And for decades, those flows have been strong enough, consistent enough, to create the appearance of permanent growth. But here's the critical distinction. Flow-based systems don't accumulate stability the same way. They accumulate exposure. Exposure to global conditions. Exposure to geopolitical shifts. Exposure to the behavior of capital that doesn't belong to them. And right now, one of the largest components of that flow, Chinese capital, is not stable. It is cautious, reactive, strategic, which means the system itself begins to reflect those traits. When flow becomes fragile. Flow works best when movement is predictable, when capital knows where it's going, when confidence is high. But we are entering a different kind of global environment. Fragmentation is increasing. Economic blocks are forming. Capital is becoming more controlled, more politicized, more selective. In that environment, flows don't stop. But they change. They become shorter, more temporary, more conditional. And when that happens in a system like Dubai, the effects are subtle but significant. More short-term ownership, more passive assets, more capital that arrives but hesitates to engage. Which brings us back to what we started with. The quiet apartments, the underutilized luxury districts, the sense that something is slightly disconnected. Not broken, but not fully alive either. The convergence of two forces. At this point, two dynamics are intersecting. Capital that wants flexibility. A city designed to provide it. On the surface, this looks like perfect alignment. But underneath, it creates a paradox. Because flexibility reduces commitment. And without commitment, economic depth becomes harder to sustain. You get liquidity, but less permanence. You get transactions, but less transformation. And over time, that shifts the identity of the city itself. from a place where value is created to a place where value is stored, from a living economy to a financial interface. The limit of the model. Every system has a limit, not necessarily a breaking point, but a threshold, a point where its core assumptions begin to weaken. For Dubai, that assumption is simple. That capital will keep coming, not just in volume, but in behavior. That it will not only arrive, but eventually integrate. But what we're seeing now suggests something different. Capital is arriving, but staying liquid, remaining detached, avoiding deep integration. And if that pattern continues, the system doesn't collapse. It transforms into something quieter, more financialized, less dependent on real activity, more dependent on perception. The final question. So where does this lead? If Chinese capital continues to use Dubai as a strategic parking ground, a place for optionality, not permanence, then the city may evolve into something entirely new. Not a traditional global hub, not a purely financial center, but a hybrid, a place where wealth exists, but doesn't fully engage, where assets hold value, but don't always generate life. And that raises a question far bigger than Dubai itself. What happens to cities when they become containers for global uncertainty? Because that's what this really is. Chinese capital isn't just moving toward Dubai. It's moving away from something else. And in doing so, it carries that uncertainty with it, deposits it into the system, and slowly, quietly, reshapes the structure from within. If you've made it this far, you're not just watching, you're thinking. And that's exactly what this channel is built for. We go beyond the surface. We break down the systems behind the headlines. We question what looks obvious and uncover what is. So if you want more deep, layered analysis like this, subscribe and let me know your perspective in the comments. Because the real story here isn't just about Chinese money or Dubai. It's about a global system in transition and the cities that sit at its center. So here's the question. If capital stops looking for a place to hide and starts looking for something else entirely, what replaces it?